One of the smartest ways to earn passive income is through the stock market. You can do that by having dividend stocks. Welcome to my first deep dive video about dividends. Dividends are payments companies make to their shareholders, a way to share their profits directly with the people who own their stock. In this video, I'm going to explain exactly what dividends are, why they matter, how you can use them to grow your wealth, and what to look for when picking dividend stocks. By the end of this video, you will understand just how to build a steady income stream through dividends, even if you're just starting with a small investment. So what exactly is a dividend? A dividend is a portion of a company's profit that is paid out to the shareholders. Think of it as a reward for owning a part of the business. Most dividends are paid yearly or quarterly, but some companies like Realty Income or Main Street Capital pay a monthly dividend. Let's look at an example. If you own $1,000 worth of a stock with a 5% annual dividend yield, you will earn about $50 over a year just for holding the stock. And if the company increases the dividend every year, that income grows over time. Dividends give you a way to earn money even if the stock price isn't skyrocketing. It's like your investment is paying you an interest, but potentially higher than a savings account or bonds. Dividends are powerful for several reasons. First, they provide consistent income. Even if the stock price goes up and down, dividends give you cash flow you can rely on. Second, you can reinvest them. Many brokers allow you to automatically use dividends to buy more shares, which means your investments grows faster thanks to compounding. Over time, reinvested dividends can significantly boost your total returns. Third, dividends signal company health. Companies that consistently pay and increase dividends usually have strong cash flow, low debt, and a business model that can survive recessions. If a company cuts its dividend, it's often a warning sign of trouble. Finally, dividends are a great way for conservative investors to earn passive income while reducing risk. Instead of relying on stock price appreciation, you're getting paid for holding a reliable company. Now, let's talk about two key numbers: dividend yield and dividend growth. Dividend yields tells you how much you earn relative to the stock price. For example, a stock with a 4% yield gives you $4 per $100 invested per year. But yield alone isn't enough. You also want to look at dividend growth. This tells you how much the dividend increases each year. Even a modest 3 to 5% growth can make a big difference over time thanks to compounding. Let's take Realty Income as an example. This stock yields around 5%, and over the past 10 years, the dividend has grown roughly 3 to 4% per year. Main Street Capital pays around 6% and has grown the dividends around 2 to 3% annually. By focusing on both yield and growth, you can identify stocks that not only pay you now, but increases your income steadily over time. When picking dividend stocks, there are a few key things to look for. First, dividend history. Look for companies that have paid dividends for many years and has increased them annually. This shows stability and reliability. Next, stable industries. Focus on companies operating in reliable recession-resistant sectors like real estate, utilities, consumer goods, or healthcare. These industries tend to generate consistent cash flow even when the economy slows down, making their dividends far more dependable. Business stability. Focus on companies with predictable cash flows. REITs, utilities, and consumer staples are often good choices because they are less affected by recessions. And lastly, look at growth potential. Even if the yield is moderate, companies that consistently grow earnings and dividends can generate impressive long-term income. Following these simple rules can help you find dividend stocks that are not just paying you today, but growing your passive income for years to come. Now, let's have a real-life example. Imagine you invest $10,000 in each of these four dividend stocks: Realty Income, Main Street Capital, VICI Properties and Coca-Cola. Realty income, which has a 5% yield, will gain you $500, Main Street Capital $600, VICI Properties $550, and lastly, Coca-Cola will gain you $300. That gives you a total of $1,950 in passive income in your first year. Now let's consider what happens if these dividends grow by 4 to 5% per year and you reinvest them. Over time your income doesn't just stay the same, it grows exponentially because of compounding. After 20 years with this approach, realty income grows from $500 a year to about $1,310 a year. Main Street Capital from $600 to $1,570, VICI Properties from $550 to about $1,440 a year, and Coca-Cola from $300 a year to about $785. Your total passive income in year 20 alone will be around $5,105 per year compared to the first $1,950 in the first year. Even more impressive, if you reinvest all these dividends along the way and each company stock price grows on average by 5% per year, which is about half of what the S&P 500 has historically returned on average, your initial $4,000 investment could grow to roughly $430,000 in total portfolio value after 20 years. This example shows the power of dividend growth and reinvestment. Starting small can still lead to a significant income stream over the long term, and you continue to earn more and more each year even without buying additional shares. It's a clear demonstration that consistency and patience in dividend investment can build meaningful wealth and a reliable source of passive income. Dividend investment isn't about getting rich overnight, it's about steady growing income that compounds over time. Start small, reinvest your dividends, and focus on reliable companies with a history of growth. Over the years, these dividends can form a meaningful portion of your income, helping you reach financial freedom. If you found this video helpful, hit like, subscribe, and comment below which dividend stock you are most interested in, and if I should make a deep dive video about one of these stocks I mentioned in this video. I'm the Smart Saver, and I will see you in the next video.